from Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB. I'm Nadine Blaney.
I'm Juliette Sarli on this shocker of a Wednesday.
Yeah, you got that sinking feeling, don't you? So many comparisons being drawn to the beginning of August.
Yes, deja
August
vu.
turned out to be a pretty solid month though, but we have slipped below that 8,000 level for the S&P ASX 200, down now by 1.9%.
Let's have a look at where the SIBO is tracking as well, because of course we had that weakness coming through from Wall Street overnight with the big Nvidia tumble, and Nvidia's nosedive, and just really playing through into the broader, I guess, tech wreck that we have seen across Asia as well. You've got SK Hynix, Advantest in Japan, so many of those big names tumbling.
Yeah, really big tumbles in Japan. Of course, Japan's market closing in tandem with ours, off by 4% for the Nikkei. More muted losses coming through in Chinese markets, but it's not good. There's some pretty big concerns out there about global growth, and I suppose you could lump Australia in there too with this GDP read that we got today as well.
Yep, well, I mentioned tech wreck. Let's get to our other themes. Life in the slow lane as we had that GDP print come through, and when you strip out the pandemic effects, it was actually the slowest annual growth that we have seen since the 1991-1992 recession, and several indicators, of course, indicating that on a per capita basis, sixth quarters now of decline, which is definitely a technical recession.
Yeah, no. So, okay, we are watching the resources space. I mean, energy coming under a lot of pressure. We had a couple of key companies trading ex-dividend today. But yeah, when you're talking to a lot of analysts, I mean, you spoke with Sean Callow today. You know, that might have been Andrew, wasn't it? Sean Callow,
I was going to let you roll
who
with
is
that.
an independent economist. It's up online anyway if you'd like to have a listen. But just to get his take on the GDP read, I was just speaking with Dina Messina from AMP. She's the deputy chief economist there, just saying, you know, things are pretty tough out there for the Aussie consumer. But she said she doesn't even know why the RBA would have a hawkish tone in their communications in the wake of that GDP
yeah,
read.
it's strange, isn't it? Just on that resource rotation as well, I found this really interesting because we know that commodities have fallen, particularly iron ore. A lot of these miners paying out lower dividends than were expected. So that really interesting aspect of where is that money going if people are going to be selling out of some of these players and moving into potentially other areas. Although I talked to James Garish from Shaw and Partners earlier, and he was saying, look, you probably missed the boat if you haven't sold out of some of these.
And then you start to say, well, I was reading some Morgan Stanley analysis today, actually. I put it up on X or Twitter, whatever you want to call it. Just that materials have been the sort of serial underperformer in August. So I wonder, if there's some opportunity there if you do think that there could be some stimulus coming, or that things couldn't get much worse.
All right, let's have a look at our tech sector after we saw that big plunge in Nvidia, and of course we mentioned that it flowed through rather into the likes of Taiwan, Japan, Korea. WiseTech down by 2%. We don't have the same kind of exposure, and certainly not really Apple or Nvidia suppliers, but still some weakness in that space.
Yeah, it's just, the whole catching a cold, sneezing, that whole sort of scenario there. I mentioned Fortescue. It is down significantly, but don't cry. It has been trading ex-dividend today. But still some losses there for BHP, for Rio Tinto. Mineral Resources, worst performer yesterday, and still some selling today, off by a further 5%.
And just having a look at energy, because of course that big slump coming through in crude as well. You've got Beach down 4%, Cooper down 6%, and the big ones, Woodside and Santos, off by about 2 to 2.5%.
Yeah, there was nowhere to hide. All 11 sectors today lower. So yeah, it was pretty dismal. What was higher was Orora. So if you remember, this company bought a European beverage maker, bottle maker. They're into packaging, and that really sent its share price lower. Well, today it had a strategic review. It decided to sell off its US business. It's left it very focused on beverage containers specifically, and so it's also improved the balance sheet. So it sold that US-based packaging company for close to $1.8 billion.
Yeah, now we saw the founder buy a bunch of Satire shares at a lower price. So he's now got a 33% take in the company, and Satire down 11.5%, $1.34.
I do enjoy reading in the AFR's Rear Window about Satire and its founders and what's going on there. But anyways, I digress. We've got Stanmore Resources in a binding agreement with Anglo American and Exaro about a project near its Isaac South land. So yeah, didn't do anything for its share price.
No, and Santos inking a deal with some of its LNG cargoes, but I think as we reflected before, that movement is really on the lower oil price. All right.
Gotta say, it's not too exciting when it comes to corporate news in the wake of reporting season, is it?
I know. I think when we were struggling to find some today, we thought Orora Seta, that's about the extent of it.
I always say to new players in the newsroom when they're really overwhelmed by reporting season, we will miss it.
Yeah, you said that to me, and I'm not a young player, and I agree. All right, another young player. No, I'm kidding. Mark Gardner.
What?
As in, I didn't want to. I thought saying a young player is then going to insult him. So
No.
I'll just
Oh, it's
take
fine.
my words out of my mouth.
I'm old. It's
You're not
okay.
as old as me.
All right, Mark Gardner from MPC Markets, who is a seasoned player, is what I was looking for.
Oh, there we go.
That's better. I've redeemed myself. Your take on Nvidia, is this, the start of something ominous, or you got to look at the fact that it was up 140% before the 10% jump?
I think it is overall. I think that entire earnings season was just really reflected the fact that AI, brilliant technology, will be a game changer, but probably not yet. So, and obviously the Department of Justice slapping an antitrust suit on it after the close as well didn't really help. But yeah, I mean, it's a supremely volatile stock, and there is a big premium in it at the moment. And they're having a look through some of their revenue. A lot of their revenue comes from the Mag 7. So if a small group of companies start cutting back, their revenues are going to drop pretty quickly as well. So, and I would expect that they would overall, because realistically, there's no money coming through. It's been 18 months to 2 years, and I think this sort of frenzied spending at the start, people are starting to realise they're not really missing out on much, because there's not a lot of revenue in it as it stands at the moment. So, similar to the tech bubble. Well, this isn't a bubble necessarily, but similar to the tech bubble. I think this is, we're in early stages of the AI thematic. And
So
I think
could you even say it's a healthy bit of a pullback?
I think
things can't go in one direction forever.
No, it can't, and I think it is a bit of a healthy correction overall. I don't expect it to go the way of Cisco and drop 80% or anything like that. I think they've got a far more stable business model, and they are clear leaders in their field. But competition is starting to catch up. Software is starting to develop to the point where you don't necessarily need those, a bunch of those high-end $50,000 chips. Software getting more efficient, and obviously, and the competitors catching up, like Huawei, etc. as well, who are now testing and releasing a very competitive chip, which obviously they can sell in China. I think we'll probably just start to see that lead, eroded from Nvidia.
Now, more broadly, you gave us a really interesting chart about the seasonal trends we see in September. Let's have a look at that in terms of, as we know, often the worst month before we sell in May, go away, come back in October, as they say. What are you seeing here? This is a Bloomberg
obviously
chart.
September, S&P obviously being a fair bit broader, but it's the only month that has a negative return on average for the last 50 odd years. So these the stats on the left are back to 1964. And look, and overall it is the worst month. It's the only month that is less than 50% chance of being up as well. And obviously October has the really horrible crown of the worst downside month, but that's more than likely just on the back of a capitulation. The Nasdaq to the right there, obviously, only one in the last sort of 6 or 7 years where September's been a positive. So, and you put on top of that obviously optimism around rate cuts is now getting a bit of a reality check. Obviously, there's an economic slowdown coming. Equity markets don't do well after the first rate cut, anywhere between 20 to 12% average downturn. So the 20% is when there's black swan events involved, but on average it does drop about 12.8% after the first rate cut, and the S&P usually is quite a V-shaped recovery, so over about 6 months. But I think we'll have some definite weakness over the course of the next sort of 4 to 6 weeks, because we've got obviously. Everyone was rejoicing the Fed initially, but obviously the slowing numbers. I think you've got ISM manufacturing numbers, 16 or 17 consecutive contractions. That's worse than the lead up to the GFC. The SOM rule as well it predicts, I think since the 1970s, predicts recession at 100% success rate, and it's been triggered. And the yield curve just popped up into positive territory, which usually there's an 80% chance of a recession within 3 months. Once after it being inverted, which was the longest period in history it's been inverted, once it pops back up into that positive territory, there's, like I said, there's about an 80% chance. So.
Anybody feel like a drink? Yeah, so what do you do then? How are you advising clients?
At the moment, small caps will probably get, we'll probably get the harsh end of the stick initially. I think that resources sector, I agree with James Garish. I think the horse has absolutely bolted. Resources sector's been factoring in slowdown for 2 months now. And you've got the likes of like Fortescue, BHP, which are extraordinary companies with high margins, trading at very mid-single digit PEs. What I'd be doing at the moment is all of those market darlings that had those significant rallies in the tech sector and the consumer discretionary sector, you just need to be getting out. They're
taking
trading
profits,
at
yeah.
Absolutely. Wesfarmers, CBA, Macquarie, particularly are trading at 5-year highs for PE, and many of them have actually said they're not going to have forward growth. So why would you be buying highly cyclical stocks when the GDP numbers today, slight growth, but to be honest, GDP per capita was down. Disposable income was one of the sharpest drops in the IMF. So
well, if it wasn't for government spending, it would be a very, very ugly figure.
It would have been an ugly number, yeah. So, and I tend to side with the RBA on this one as well. The government's got to be. I mean, we used to have them both heading in the same direction, and and I think the government's just got to get on the same page. It's an economic cycle. It's happened for hundreds of years, and you can't just get infinite growth forever.
So if you are taking profits out of some of those winners, would you keep it in cash? Because if September is going to be a rough month, potentially bleeding into October, do you think that the big opportunities are yet to come?
I think that they are. Everyone should probably watch the alternative,
I
essential
was about to say,
alternatives.
that was your big you plug, but he did it for you.
So we've actually got a couple of strategies there in structured products to basically get paid high yields to re-enter about 20% lower. So they're, that's one way of doing it. But obviously you can sit in cash for a while. Look, some of these stocks have had incredible runs. They've outperformed the index by 20-25%. Or more in some stages. There's no shame in taking some profits, realistically, but there is a lot of red flags stacking up all at once, coupled with that seasonal weakness. I think it's probably time, particularly in the Australian market. We've got 6 months to earnings again, so it's not going to be a lot to save some of these companies that are trading at these incredibly high PEs if the broader market weakness sort of starts to be an overwhelming tide against it. So I think it's definitely a period to be staying safe. Some people like the short ETFs. I think that's a very tricky trade overall, but there's a lot of signals at the moment that suggest that it's been a good year, particularly in AI and all these stocks. So how much is enough, I suppose.
Yeah. All right, always good to get your insights, Mark. Mark Gardner from MPC Markets.
And just that conversation reminded me that the latest investment committee episode is up online as well, Jules, ausbiz.com.au. If you are listening to this in podcast form, it's under the series. We'll put it in the editor's pick as well, if you don't mind. Did you? Okay.
I did, yeah.
And it's just good to hear what those guys are doing, obviously as well with the fantasy portfolio. And I can tell you, cash does come up in the conversation. I'm not going to give it all away. You have to take a listen to it.
All right. Well, the stock of the day, Orora, Henry Jennings from Marcus Today and Andrew Allard from DP Wealth Advisory.
You can see on the graph there with the 5-year chart, those results did push the spike there back in August, the middle of August. So those results were enough to sort of suggest to the market that Saverglass was turning the corner, although they do look as if they paid a little too much for that. So I guess on balance, for me, this is a hold now. It has done the hard yards. It's probably around sort of fair valuation. Debt down, good news. that transaction good news. And they've just now become a simpler, more focused company, I guess.
On balance, like it's a defensive business. Certainly having 1.7 billion of cash in a sports bag is certainly not a bad position to be. You can certainly see why the CEO is upbeat, and why wouldn't you want to come to Queensland and expand? So he's got a couple of reasons to be happy, but from a value point of view, it ain't value. It's okay, but it's not value, so it's a hold.
So a hold for Orora from both of my guests. There was quite a thematic of holds today, but the guys did agree on, I think it was one buy. You'll have to listen to that episode to find out which one. I can't remember off the top of my head, honestly.
It's been a big day. All right, market leaders on a down day. Orora obviously there. Nanosonics up 3.8%. Bega, the owner of Vegemite, up 1.8%. And Chorus and Webjet also looking good.
Some things you hear once and you just never forget it again. Deep yellow down by 9%. Fortescue on the flip side also down significantly, trading ex-dividend. Look, not a lot of news associated with the rest of these guys, but talking about that resources rotation.
Yeah, and lithium, when just looking at Liontown, Sean Hickman from Market Matters wrote our view today for our newsletter. He's got a really interesting piece on lithium and his particular picks that he likes, so you can read that in our newsletter this afternoon.
Picks in the lithium space. Haven't heard that in a while. Let's get to some of the small to mid-cap companies. Look, just here's a bit of a motley crew. We've got AMA, Shine Justice, and on the flip side, Jules, we've got probably some energy names. And yep, there you go, Orora Energy and Elixir Energy as well.
All right, tonight we are looking forward to the factory orders and trade balance out of the US, along with the JOLTS job openings, all of these July readings, and the Fed's beige book as well.
Yeah, that'll give us some insight as to how things are tracking on a state-by-state level, so perhaps some information about demand and consumers as well. Here tomorrow, we hear from the RBA Governor, Michelle Bullock.
Twice.
Yeah, so this is, I know market participants have been really looking forward to this. So I wonder what she'll say about today's GDP read, which of course was less than stellar.
Yeah, and so I think she's speaking in the morning at the Annika Foundation and then the evening at the Women in Banking Finance Awards. So it'll be really interesting as well to see, is it a copy and paste, or is she going to give some more clues into things in, throughout the day?
Yeah, and I do believe that there is the opportunity for Q&A in the evening as well. So sometimes the most interesting stuff comes from there. And I will say, yeah, the BOC, so the Bank of Canada, meets tonight as well. We missed that one, but expected to deliver yet another 25 basis point interest rate cut. So that'll be an interesting one to digest tomorrow morning.
All right, let's have a quick look at the market action as we round out the day. It has been not a good day at all. A whopper of a Wednesday. Well, that's, yeah, but I don't know. Is whopper means something good, doesn't it? A whomping.
A walloping.
A walloping
this Wednesday. That's the word. NASDAQ and S&P 500 E-minis are quite a bit lower, I should say. Just time-stamping this for those of you listening in podcast form. About 4:20 here in Sydney. So yeah, it's not looking very positive out there. Oil coming under pressure, of course. Yeah, we're in a little bit of a purple patch, it's starting to feel.
Yeah, and just talking about some of the interviews that you can catch up on online. David Scott mentioned to me Deja Vu, is this the beginning of August all over again? You can find that one. And then Tony Sycamore said a really interesting thing to Andrew as well. Was August the entree to September's main meal? So you can find his picks there too.
Yeah, interesting. Maybe Scotty talked about what to expect from the jobs report. I know that he said last week, I think I just saw it on social media or something, that this is, that US jobs report is the report to end all reports, like perhaps the most important report of the year.
He was saying that the ADP, which he never thought, so yeah, exactly. He was saying that he's now moving to the thought of the ADP private employment report being more important than the non-farm payrolls.
Really?
He said he never thought he'd
Changed
say
his
that.
tune.
Indeed. All right, lots of good conversations. You can catch up ausbiz.com.au.